So is the Indian growth engine slowing down? GDP for India for the second quarter of the current fiscal has come in lower than expected. The expectation was 6.5%, it's come in at 5.4%. It makes it the slowest phase of growth in a span of 7 quarters, which is also slower than that of the previous quarter, which was above 6%. The GVA for the same time period has come in at 5.6%. But we got in a word from the Chief Economic Advisor, Nageshwaran. He calls this slowdown unalarming. He also negates the notion that this may turn into a trend. The question is, what is the real picture then? Let's get you an excerpt of what the Chief Economic Advisor has said.
Real GDP growth print of 5.4% in fiscal second quarter of the current financial year 24-25 is on the lower side. It is disappointing, but we would like to point out that it is not alarming situation. There are quite a few bright spots. In comparison to the expectations, it's on the lower side. And I think we are still doing better in comparison because the global environment was challenging in the calendar third quarter. And agriculture has done quite well. In fact, these are the bright spots. If you look at the growth rates year on year in the gross value added segment, agriculture, livestock, forestry, and fishing had a growth rate of around 1.7% in Q2 of last year. And then it was a very tepid 0.4, 0.6, and then 2%, improving to 2% in the first quarter of the current financial year, further picking up to 3.5% in the second quarter. That is a bright spot. The other bright spot is construction. We can see that construction sector over the last full year has been growing at very high single digits and continued that growth rate in the first half of the current financial year as well. These are the bright spots. The passenger vehicle sales in October helped the industry clear a lot of inventory, two-wheeler and four-wheeler sales, and domestic air passenger traffic handle has not only seen a level shift up in the volumes compared to the previous 2 financial years, but you can see the slight upswing on the right side of the right side chart in the green line in September and October as well. Rural demand has been a bright spot, as we have been writing in the monthly economic review, which we publish around the third week of every month. On the left side, you can see about 7 consecutive quarters of growth in rural demand based on the Nielsen IQ data, and two-wheeler and three-wheeler sales as well in rural India, while tractor sales is at an all-time high because of the expectations of a good Rabi crop on the back of a Kharif crop as well. There are enough reasons to believe that this 5.4% is one-off rather than the beginning of a trend.
Enough reasons. The Chief Economic Advisor believes that this is not going to be a trend, it's a one-off. Let's see if our economists joining us on our panel tonight agree with what the Chief Economic Advisor is saying. Garima Kapoor is an economist and Senior Vice President at Elara Capital, and Siddhartha Sanyal is Chief Economist and Head of Research at Bandhan Bank. Good evening to you both. Now we've kind of understood, digested perhaps what the Chief Economic Advisor has said. Garima, GDP growth now in the second quarter, it's the slowest in 7 quarters, yet we're hearing it's only a number, it's not a trend. Is it a matter of concern to you? Are there signs that the economy is slowing down?
I would agree and disagree both. One, at 5.4%, of course, it's an aberration. It was affected by one-offs like heavy concentrated rains, still gradual pickup in government spending. And third, not to forget, during this time, we also had a sluggish impact of slowdown of demand. Now, but when we look at the trends in quarter 3, which was certainly a festive season, festive month, we do not get very encouraging signs. Channel checks suggest that there has been a pickup, but the pickup in consumption has been patchy. It's not been broad-based, number one. Number two, as I look at the government spending, especially on capex data, The month of October also has shown a degrowth. That means you're looking at the degrowth of FITD of 15%. Number three, RBI's crackdown on a lot of lending, particularly on the personal space, has also impacted demand. And fourth, importantly, the expectation that rural demand is picking up may not really play out as expected because our checks and our understanding of the rural economy says that while output is good, the realization for farmers hasn't been great and there is no significant uptick in the consumption demand. So while I will agree that 5.4 is an extremely low number because of certain one-offs, I won't say that the trend in the second half is going to be significantly better than the first half. In fact, we've cut down our growth estimates further by 30 basis points, and we now stand at 6.5% for full year versus 6.8 earlier.
Specifically mentioned the agriculture sector, and that to the chief economic advisor seems like a growth driver at this stage. So you're saying the output has gone up, but realization for the farmers hasn't been that significant. Siddhartha, Sanyal, what's your take on this? Because we're talking about subdued urban demand as well, isn't that a matter of concern that it may gain momentum going forward is what the chief economic advisor believes. But are you seeing financial stress for India's urban middle class or even rural India right now with rising inflation, also a slowdown that we are seeing in wage growth?
I think financial stress might be a very strong expression, but I tend to agree a lot what Garima just mentioned. I think she summarized it nicely. Very clearly, the 5.4% agree with the chief economic advisor that that number might be an aberration and subsequent numbers will possibly be significantly better. But very clearly for the full year, at this moment, it's very, very difficult to imagine any number close to 7%. The number will be materially lower. The first half average at this moment is at around 6%. So you will at best will be somewhere in the mid 6% kind of a zone. I think that particular expectation was taking shape to some extent over the last few weeks and last few months. And this particular today's print is very clearly a clear indication and confirmation of that particular trend. Having said that, I would possibly say that there has been a very interesting development in terms of in the GDP accounting. There is private consumption, there is government consumption, net exports, etc. And there is an others component. And this particular others component had been very strong in the last financial year. This particular financial year, it's actually contributing negatively for the last 2 quarters. So my sense is that at this moment, you will possibly get a mid 6% or even a low 6% number for the full year. Eventually, when subsequent GDP revisions take place, last year's 8.2 will also come down. This year's low 6% or mid 6% number will inch up slightly.
Is the truth. We are likely to see it go well below the RBI's potential for the Indian economic growth story that they have targeted. Garima, what are the real problems that you see right now? Structural challenges that you see within the Indian economy? Are you, because particularly I'm looking at manufacturing and mining. They're turning out to be the pain points, even as we speak about farming, and the chief economic advisor hinted at construction and farming. But when you look at these two major pivots as far as the economy is concerned, how do you think them faring and how much of a bearing is that going to have on future numbers?
Broadly, what's happened in the manufacturing sector, and that's true for almost the entire listed universe space that we look very closely, is that the commodity pressures are gradually inching up. And because the demand is moderating, you are seeing pressure on the bottom line as well. So the operating profitability of a host of listed universe, so more than 7,000 companies that we look very closely, degrew very sharply in second quarter. And if I want to now expand this to the horizon of Q3, while demand might moderately improve, there are no strong signs that there is any immediate improvement in the input price pressures. So you are likely to see probably profitability remain sluggish in the near quarter as well. And having said that, the other aspect to remember is that mining and manufacturing do tend to get excessively affected in the second quarter, because this time, while the headline rainfall was okay, we had heavy and concentrated rains, particularly in towards the end of the season, and the withdrawal of monsoon was also well towards October versus September. So some part of the numbers that you're seeing right now could be an impact of this. But broadly, the results season so far for quarter two, financial companies that we've seen, financial and non-financial companies, the number of misses have been far higher than number of beats. In fact, among the universe of companies that we look at, the number of misses are more than 50% compared to same time last year, which were about only 35%. So that's telling you something, and that's telling you the trend is towards moderation and that the momentum is gradually slowing. You can partly blame it on the fact that government spending has been sluggish, both capex and revenue, or you could also say that the wage growth on the urban side has now started to moderate on the real basis. So it's a combination of all put together. Of course, as government starts to spend more, the momentum will pick up. But I think some of the aspects that you're seeing in the manufacturing growth seem to be more endemic and are likely to persist in the near term, even if the degree of slowdown or degree of moderation tends to be not as bad as what we've seen this quarter.
So, Garima, if you're seeing the momentum slow down of growth in India, is it much more for domestic factors? Because those are the ones that you've listed. It's not particularly global headwinds?
There are global headwinds, but remember, as we talk, US economy is still doing quite well. We see resilience in the numbers still as yet. In fact, you will probably see a Federal Reserve going for a pause either in December or in February, Jan-Feb meet, partly because your unemployment numbers are not looking as bad and your inflation numbers are looking higher than what was estimated. So I think it's a kind of a mixture, but I would say what we are seeing in India seems to be more driven, relatively largely driven by domestic factors vis-a-vis global. Remember, global headwinds have not even started to play out. We've not even seen the impact of tariff. We've not really seen a situation where US fiscal deficit or ballooning of fiscal deficit starts to be very aggressively on US yields, and hence, of course, the cost of debt across the world. So I would say not yet global, largely domestic in this quarter.
Global headwinds could make matters worse, is perhaps the underlying message that you're sending out. Siddhartha, you believe this as well? Because like Garima is saying, she's expecting a pause perhaps by the Fed when it comes to rate cuts. They've started that cycle. What do you think the RBI is going to do? This kind of GDP print, how does it affect expectations of the RBI's policy trajectory now?
It's actually putting RBI in a very uncomfortable situation. And it's very true. I completely agree that the domestic factors are playing a very big role at this moment. See, in terms of the most important number for a GDP release often is how India's private consumption is performing, and this particular area was a huge pain point. Even when the headline GDP growth was 8.2% in the previous financial year, the private consumption growth was 4% in FY 23-24. This particular number improved substantially in Q1, but that number has started coming down in this today's print again. Now, today's print, this particular number fell from previous reading of close to 7.5, close to about 6%. But the more important thing here is in this particular print, there was a hugely favorable base that was there for this particular number of private consumption in this particular quarter. Last year, this particular quarter, private consumption growth number, if my memory serves me right, was around in the around 2.5% year-on-year growth, and this particular number is 6% on top of such a weak base. That means that the dampening in consumption demand you cannot completely brush aside.
Yes, and also, we are looking. Yes, go ahead.
Yeah, and also, if you actually see how the external sector has been behaving, the import component has actually come down quite significantly in this particular quarter.
Yes.
Had the import growth not been coming down, that could have actually led to even sharper softening in the growth trend.
Right.
So actually, there is a lot of factors for the domestic side, and that actually brings RBI to the most difficult situation.
Yes.
Inflation is way beyond their headline comfort zone. So my sense is that with the current headline inflation and currency volatile, they are not in a position to cut. It will be absolutely unrealistic to expect them to cut, but they have to continue injecting more liquidity in the system to support the economy at this stage, which thankfully they have started doing in the last couple of months.
So if we can't do monetary measures, if we can't have monetary measures do the trick for us right now, what do you think, Siddhartha? Now the government is thinking, will fiscal measures really help? Only yesterday we were gleaning source-based news that the government is going to accelerate the stalled infrastructure projects to give capex a boost for the remainder of this fiscal. There's a lot of catch-up to do over there, but can they actually help increase capital expenditure? Can it offset this sluggishness that we are seeing? At least in the short term, can that happen?
I would not expect immediately the government to, going back to the drawing board and allocating a lot more budget. But what will possibly be the case that some of the government spending part, which was slightly slow in recent months, will possibly gather a little more momentum. But also from the monetary policy side also, that monetary policy is not only about rates. In fact, there is a very significant role of liquidity. My sense is that the RBI would have to take a recourse to providing more liquidity. Just to wrap up that particular discussion, if you see the one particular measure for how much liquidity RBI is giving to the market is the RBI's reserve money growth. And this particular reserve money growth, the long-term trend is a growth rate of 15%. This number for the last 2 years grew at around 6-7%. So half of the usual trend rate. Thankfully, this number has started going higher in the more recent months. My sense is that this number you will get to see inching a little higher, and that will be the support from the monetary policy side also.
We'll have to wait and watch what support the monetary policy gets, and as far as the government spends are concerned, whether or not that pickup is actually going to help. But this slowdown, like the chief economic advisor is saying, a temporary blip. Whether it is or not, again, it's going to be a test of time. But a prolonged soft patch for the Indian economy will have its impact on the markets as well. Thanks very much for joining us with your perspective on this. It's always a pleasure getting in your views. Siddhartha, Sanyal and Garima, Kapoor, pleasure having you on India Tonight.
If you like this video, then like, share and subscribe to ET Now.